Welcome to the Macro Mob. You're joining us during a segment that we like to call Macro Hits, where we just go over brief news stories, things that we found interested. And if you didn't know it before, we are completely unqualified and uninterested in providing you social, financial, legal, or life advice. My name is Sean, and I am joined by my co-host, Damien. What's going on, Dame?
Hey, how are you guys, everybody?
So we're doing good tonight. So I think that you wanted to go ahead and start off the show. I believe you had like a little PowerPoint that you kind of worked on dealing with some of the things that are going on with credit reporting, the credit markets, things like that. What exactly did you want to talk about?
Yeah, there was, if people kind of checked out the news this week, there was a big to do about a proposed change to credit reporting that should happen this summer. And what caught me by surprise was how overwhelmingly positive the news articles were about this change. And so I did some looking into it. It's going to affect a lot of people. Millions of Americans are going to be affected by this change. But I want to dig into it a bit and, just present a few issues so that people can think for themselves and say, hey, is this really positive or not? I'm going to share my screen with you all. And so, again, this is being sold as a major change to credit reporting coming this summer. As most people know, there are three major credit bureaus. And anytime you apply for a mortgage, you apply for a loan, you're trying to get a car, one or more of these companies are going to provide your credit information to the seller. And very often, most banks use at least two of these in coming up with your score. For those of you familiar with Experian or Equifax, you'll know that when you compare your scores, one might be higher, one might be lower. And they have different reasons for that. But these are the three main companies that are really behind our credit score system today and that have a lot of influence on what the average American can even buy. Now, there are people like Dave Ramsey who say that, your credit score doesn't really matter. But I think that for most people, the reality is quite different.
Right, because he's talking about manual underwriting, where for most of us, things are.
Yeah, and he's also talking about putting, if you can put 40 grand down on a house, then you're fine. So the major change that they're talking about has to do with medical debt. For as most people probably know, your credit report shows the history of your good and bad decisions. Okay, your things that you've paid off. Things from student loans, and also payments that you've missed or things that have gone to collections. And one of the biggest things that have gone to collections on most Americans' credit report are medical bills. So the idea behind this change is that they're going to do two things. Okay, they're going to drop any paid medical debt that's on your report in the amount of $500 or less. They're going to remove that from your credit report altogether. Typically, what happens in a credit report is, most people probably have heard this golden rule of things stay on there for about 7 years. That's not always true. But let's say you, broke your wrist and you got a sling, and that sling cost you $400. And you were paying on it, but it eventually went on your credit report. Let's say that you paid it off last year. Normally, that would still be on your credit report going forward a few years because you either missed the payment or they hit you with that credit reporting. But now that would come off of your report completely. It would be as if you never missed a payment. It would be as if it never went to collections. So that's kind of a big deal because a lot of people have hits to their credit in small amounts. And if you could get off something like that, it could affect your score positively. The other major change is that they're going to increase the time period before those debts, medical debts, even show up on your credit report. So as a general rule, let's say you go to the hospital, okay? And I see this a lot with clients of mine. You go to the hospital, you get a hospital bill. The hospital will send that to collections or sell your balance to collections sometimes before you can pay it off. Well, the collection agency, after threatening you with phone calls, will typically hit your credit report within 6 months, okay? Not before. So what's going to happen now is these agencies have agreed that they won't even let those debts, again, in this $500 range, hit your credit report for a year. Okay. So that's also could be a big deal. Again, you may have you go through a hospital, and I won't mention any names, but typically the way it used to happen is you go to the hospital, the emergency room, and you kind of get one bill. Now you leave the hospital emergency room, you've got an ER bill, you have an ER physician's bill, you have a radiology bill. Sometimes you have more than one radiology bill. You may have bills from several different departments that are all small, and any of those could go to collections. So it may take you time to find those all, and giving consumers that extra time might actually be helpful to them, to help them pay the bills, to keep them from hitting their credit in the first place. So those are the two basic things they're proposing. Well, why are they doing this? Okay, what's behind the change? If you read these articles, again, they're overwhelmingly positive about these proposals. Here's why they say it's happening. 1 in 5 Americans, American households have healthcare related debt of some kind. I think it's pretty well known that the American healthcare system is very expensive in comparison to others. I think it's pretty well known that healthcare costs and health insurance are, complicated things. And so it's not unusual for people to have a small event or a health related event and be in debt pretty quickly. According to the Consumer Financial Protection Bureau, Americans have about $88 billion of medical debt. What shocked me, and that's what's on their credit reports, that's not considering the other debt that's not there. What shocked me is that 70% of that debt is in collections and is valued at $500 or less. So again, this is what I'm talking about. Most people think, I'm so afraid to get sick because I'll go to the hospital and end up with a $30,000 bill for going in and getting a shot and getting looked at. Well, that may be true, but the dangerous part is your health insurance will probably help you, if you have that, will help you with the bigger bill. But you're going to be stuck with a lot of these tiny providers who are, billing on the margins. And those are the things that are under $500, and those are the things that are going to impact your credit negatively. The other thing is medical debts, as I said before, is often sold to these collection agencies really quickly. In my business, I look at a lot of medical bills for clients, and they've been written off or adjusted. So it looks like there's no balance. And normally what I find is the hospital didn't even send it to the insurance. They wrote it off, or they sold it for pennies to a collection agency who now has that power of threatening to hurt your credit report. So what happens is that medical debt might not even be correct. It's outdated. If anybody's ever tried to remove something from their credit report, they probably know what a pain that is.
Yeah, they once you remember, that's if you want to get something off your credit report, you got to stop at that red light and you got to get that sign that somebody put on the light pole. You got to call them to fix your credit.
Right.
That's
And you have to write. You actually, in some of the like TransUnion, a few years ago, you had to write them a letter. In 2022, you've got to get a stamp, send it by Pony Express, and if it's not received, by the third moon, you're screwed.
Oh yeah, if that doesn't tell you right there that debt is somebody else's asset, I don't know what is.
Right. Well, here's some of the other things the media is saying is behind the change. Okay. The current administration, when they were running, did make a big deal about threatening to, come down on these credit agencies. And one of the things the administration suggested they may do is create a public credit bureau. Now, whether or not a government credit bureau would be any better than private credit bureaus is something, you'd have to decide. But, the concept has been talked about before. The idea would be to, again, break the stranglehold of these three companies who are kind of a triumvirate monopoly. Also to try and twist their arm to fix some of these consumer issues, these complaints about, hey, I have a relative who has a very similar name to mine, and some of their things are on my credit report and they won't remove them, even though I've asked 20 times. Okay. So you got things like that. And some people have noticed, particularly with, let's say with student loans, if you paid off some or it got switched to a different agency, 7 years has gone by and they haven't taken it off. And in that 7 years, that's a long period of time that you may have gotten your finances together, your debt together, and that item is still hurting you. So that's one thing that's being said. Maybe this was some political pressure. Again, I think you have to evaluate whether the current administration is really genuine about getting on companies or not. Along with that is the line that's used a lot that, hey, these changes need to be made to protect low-income and minority communities because they're the most negatively impacted by medical debt. They're also, overwhelmingly the statistics show that they're negatively impacted by all sorts of debt. And these are the same credit agencies who are encouraging them to get in debt. So who knows? And then the latest thing is to say, hey, this is a response to the pandemic, medical crisis. A lot of people who didn't have medical bills now have medical bills. My guess is most of those bills are more than $500. But again, this is how it's being sold as a positive change. And there's some truth to that. I think the real question, though, is this really going to make any kind of difference? In 2020, the credit agencies came up with something called FICO 10 and FICO 10T. Now, what FICO is the scoring system. And there's been a FICO 8 and FICO 9. And essentially every so often, the credit agencies come up with a new strategy of evaluating your spending habits and your debt habits to create your credit score. Okay. So the latest significant change was 2020. And what FICO 10 and FICO 10T represent are trends. Okay. And essentially, they decided that they were going to start looking at the last 24 months of your activity to base your score on. Trends in your spending and trends in your debt. Okay. Missed payments, consolidating your credit cards, increasing your credit card use. So the funny thing is you have to ask yourself, right? If they're still using this system of scoring, what have the past 24 months been like for most Americans or most people in the system? Do you think they've been consolidating their credit cards, using their credit cards more, going into debt more because they were stuck at home or they couldn't work or, so when you step back and look at it, if that's their scoring system, what's a $500, discount going to get you? Again, $500 doesn't sound like very much, and we know this in the context though of 56% of Americans can't cover an unexpected expense of $1,000.
Yeah, it depends what you need to use $500 for. If you said, hey, I want to spend $500 to go on vacation or take a flight with the expensive they are, I'd be like, hey, that's not very much. You go spend $500 at the grocery store, you could you're not going to get as much as you used to, but there's some pretty creative and intelligent and frugal people who can really stretch that money and put some food in your stomach. So
yeah, one of the scariest figures I came up with I didn't come up with it, but Bankrate.com has this comparison that number was 39% before the pandemic. Okay. So in other words, this short period of time, which is or is not over, put a whole bunch more of Americans in a position of economic security. And the result of that is that when they ask people, hey, what would you do if you got an unexpected $1,000 expense? Now, the same question a few years ago was $500. Well, 20% of the respondents said they're going to use a credit card to cover it. Okay. Others said they would go into savings, realistic or not. So at the end of the day, what the reason this caught my attention was that I thought these headlines, and I encourage people to just search for this topic and step back, and I think you'll be in awe of the positivity in these articles. And I just thought it's a bit misleading, because it's really what we often see from these companies. And, I'm not taking a political position on this, but I think this seems like a very minor fix to avoid perhaps some political pressure at a time where, the medical debt is becoming a bigger and bigger part of our economic debt as households. And then the last thing I would say is, think about how reading those topics will be received by most Americans. I think when you look at these articles, most people will come away from it and think, hey, I'm getting a $500 break on my credit. So that's $500 I can spend that I couldn't spend before. And that's probably the wrong lesson to take, but that is how this is being sold. And, I think it's an important thing to consider in terms of where we're at right now. And and if anybody watching has some questions about this topic or has some opinions on, we'd love to hear about it, and please hit us up. But that's my first hit for the day.
I thought it was pretty good. I do think, maybe listen. Look, if you pay somebody a decent enough money, or they're desperate decent enough money, they can write anything into a positive light, right? Doesn't mean the vast majority of people. We have to get out of this idea when people present information about how the majority of people are that simple, right? Now, I do think people are going to be like, oh, that's a little bit of breathing room, depending on the other things they could be struggling with. I mean, everything's going up in price, right? So even if it's like a little psychological, like, woo, little windfall, it doesn't really put any money in your pocket, right? Because when it comes down to it, if it comes down to, something that you need to take care of yourself or your family, that comes first, rather than paying somebody back their debt. For most people, they're going to make that decision.
I think that's been a trend these last couple of years. Whether it's the government or corporate America, they believe they have a pulse on the psychology of the American consumer. And, there's another topic we're probably going to talk about, which kind of relates to that. It's the give people a discount or give people a check, and their behavior won't change, and they'll keep spending. Even though if you do the math, it's really not a smart decision. But
yeah, well, okay. When you say it that way, I understand they can trick us a little bit. Okay, I'm just trying to give people credit. Okay, we've been here a long time on this earth. We're smarter than they give us credit for. All right.
Yeah, I have faith in people as well.
Yeah, good. All right.